guys, this is Alan from Hirose Financial. How are you today? It's been a while since we last talked about forex trading. So for today, the first corner is gonna come back, and we're gonna talk about a risk that is we're gonna encounter often in forex trading, and then how do we avoid this risk. The one of the most common and most often risks that you're gonna encounter in forex trading is that there is possibility for your trades to be closed automatically. So just in order to hold or maintain a position in forex trading, you do need to have enough funds in your account to support your position. So when the funds in your account is not enough to support your position, then your positions are going to be closed automatically. So this is what we call the stop out. So for today's lesson, we're going to take a look at how do we avoid stop out in forex trading. So let's take a look at it. Okay, in order to understand stop out, then we need to understand one term in the forex trading, which is the margin level. So margin level is you can find margin level in the MT4 platform. If you log into the platform, then you will see a information bar there that where you can find the margin level. So margin level is displayed in percentage. So if margin level is reached to 100%, then your trades are gonna be closed automatically, and which meaning that when the margin level is reached to 100%, then the stop out is gonna happen. Okay, now let's take a look at this chart here. So this is a chart that represents the meaning of different margin levels. So on the left hand side of the chart, you will see that there are few different margin levels. So 200, 150 and 100. So let's take a look at the meaning of these margin levels. So when margin level is at 200% or above 200%, then there's no problem for you to make new trades, or there's no problem for you to with your position. So but when the margin level is reached to 150%, then that's when the margin call is gonna happen. So what margin call does is that it is simply a alert for you that notifies you that you need to top up your account, and or you need to close some of your positions so that you can have enough funds to support your positions. So that's what margin call does. So margin call is at 150%. So but then if you don't top up your account, or if you just leave your positions like that, and if the margin level reach to 100%, that's when the stop out is gonna happen. So when the margin level is 100%, then all the positions that you are holding is gonna be closed automatically. Okay, so now I think you do have a rough idea of how to avoid being stopped out. So the best way to avoid stop out is actually to have a large amount of funds in your account. So just to give you a better idea on the importance of balance of funds in your account, let's take a look at another example here. Okay, so we have two guys here. So these two guys opened a position at the same time, and then they both spent $12 on their position. So in here you see the term equity. So equity simply represents the current value of your trading accounts. So if your trades, if your positions are making money currently, then your equity is gonna go up. If your position is losing, then your equity is gonna go down. So now let's take a look at trader A. So trader A has $20 in his account. The equity is $20 now. So when he make a $12 position, then the moment that he execute his position, then the margin level is already at 166%. So that is a really close to margin call. So if in this case here, if the price goes against him just a little bit, then there is a high chance for him to have his position closed automatically, which is the stop out. But then let's take a look at trader B. So trader B here have $50 for his equity. So when he opened a $12 position, then the margin level when he opened the position is at 416%. So that is really far from the stop out level, which is 100%. So in this case here, even though if the price goes against him, then he still be able to maintain his position, and then there is a high chance for him to turn his position into profits. So this is how important the balance, the equity is. So equity is actually calculated based on account balance. So if you increase your account balance, then the equity is going to increase as well. So that's why the best way, the most efficient way for you to avoid stop out is actually to top up to have a larger amount of funds in your account. Okay, so well, now this brings us to another question. It's actually the one of the most asked question when it comes to forex trading. So people often ask how much do they need to start trading in the forex market. So well, to take a look at this, we will take a smaller trade volume as an example. So let's take a look at the an example that we use micro lots. So one micro lot is equal to 0.01 standard lot. So in order to open a micro lot, then you do need to invest roughly around $11 to $12. So let's take this as an example. Okay, so well, how much do we need to open and maintain one micro lot position? So just to be clear, and if you want to trade in the forex market, and if you're really looking for traffic in the forex market, then to open and maintain one micro lot position, then you need at least $50 in your trade account. So if you do have $50 in your trade account, then you can now start trading in the forex market if you want to trade with micro lots. So well, just to remember that this $50 is not the trade volume, it's not the money that you're gonna put in all in once. It's actually an insurance of your position. So it ensures you that you do still have chance that even though if the price goes against you, you will still be able to maintain your position, and then you do still have chance to turn your position into profit if you keep it there. So but then if you only have $20 or below $20 in your account, then the chances of you getting stopped out is going to be much higher. Most likely your position is going to be closed automatically just within a short period of time after you opened your position. So a lot of traders a lot of beginners actually have a weird thought that they think that they can start trading in the forex market by only having $12 or above $10 in their accounts. So well, this is not wrong. So you can actually open a position with roughly around $10. But then if you only have that amount of funds in your account, then the moment you open your position, that is really likely the moment that your position is going to be closed automatically. So just if you don't want to waste your money in forex trading, then I do suggest you to have at least $50 in your trade account. So well, that's pretty much it for the stop out and margin call and margin level. So that's the lesson for today. And if you do have any question on any of the terms or the explanation that I talked about just now, feel free to leave me a comment down there, and then I can try to give you a more detailed explanation. So well, if you like my video, give me a like and subscribe to my channel for more live trading video. And if you are interested in the forex trading, don't forget to follow the next Forex Corner on next Friday. So okay, so that's it for today, and I will see you soon again next week. Bye.